Welcome to Talk Tickers. Today, we're diving into Vasta Platform's latest earnings. Now, on the surface, the growth looks pretty solid. But the real story, the thing that caught our eye, well, you have to look at the cash flow statement. We're going to uncover why this massive surge in cash is the key takeaway. Let's get right into it.
Here's how we're breaking it down. First up, we'll hit the big headline numbers. Then, we'll dig into that revenue to see what's really driving things. The main event, though, is in Section 3, where we solve a puzzle. How did margins dip while cash flow just exploded? After that, we'll listen to what management is saying about the future, and finally, we'll wrap it all up with our verdict in the next call.
All right, let's kick things off with the big picture. How did Vasta actually do in its 2025 sales cycle? Well, these first few numbers, they paint a really strong picture.
Net revenue was up a very healthy 14%. And this isn't just a fluke. This is actually the fourth year in a row that they've posted double-digit growth in their core business. That shows some serious consistency.
Profitability saw a nice bump too, with adjusted EBITDA growing by 10%. Now, you might notice that's a little bit slower than the revenue growth. And yep, that's a hint that there's some margin pressure, which we are absolutely going to get into in a minute, but still, a solid number on its own.
And here it is. This is the number that just jumps off the page. Free cash flow. It didn't just grow, it exploded, up 117%. We're talking about a massive leap here, and it signals a really fundamental shift in how this company turns its profits into cold, hard cash. Honestly, this is the key to understanding Vasta's story right now.
So, this table just wraps it all up neatly. You've got solid growth in revenue, solid growth in EBITDA, but then this absolutely staggering increase in free cash flow. And it's that cash generation that really powered the 32% jump in net profit. All in all, a very, very impressive quarter.
So let's talk about that 14% revenue growth. Where exactly did it come from? Let's peel back the layers and see which parts of the business are really firing on all cylinders.
The revenue mix here tells a really important story. The core subscription business, that's the giant in the room, making up almost 90% of revenue. But the real action, the hypergrowth, it's happening in that much smaller complementary solution slice.
And this slide breaks it down perfectly. The core subscription business is chugging along, up over 14%, that's great. But just look at the complementary segment. It's rocketing ahead at over 25% growth. This tells us their strategy of selling more stuff to their existing customers, it's really working. Meanwhile, the public sector business is holding steady, but their new bilingual education arm called Startle is shaping up to be a real engine for future growth, with over 50 new contracts already signed.
Okay, on to Section 3. This is where we get to the heart of it, the real puzzle of this quarter. How in the world can margins go down a bit while your cash generation just goes through the roof? Let's figure it out.
And here's the mystery in black and white. On the one hand, profit margin dipped by a full percentage point. Management says that's because of product mix and some new investments. Okay. But on the other hand, the company's ability to turn its profits into cash, what we call cash conversion, it skyrocketed to 64%. That is a huge improvement. So, what gives?
Well, the answer isn't magic. It comes down to a series of really smart, deliberate moves by management. As you can see, they automated collections, they figured out how to speed up negotiations, they got disciplined about their own payments, and they even managed to collect some revenue ahead of schedule. The big takeaway here is that this cash surge wasn't just a lucky break, it was engineered.
So, with such a strong quarter behind them, what's next? Well, management's comments during the Q&A session gave us a pretty clear roadmap for the future.
This quote from the call is about as direct as you can get. An analyst asked about the 2026 outlook, and management just came right out and said they expect mid-double-digit revenue growth to continue. They are clearly signaling a lot of confidence that this momentum is here to stay.
Let's pull all their guidance together. They're aiming for continued strong revenue growth. They expect to keep taking market share, and they think their complementary services will keep growing at over 20%. But maybe the most important piece here is their pricing strategy. They believe they have the power to raise prices above the rate of inflation. That is the very definition of a confident outlook.
And that brings us to our final section, what we call the next call. Here, we take everything we've just gone over and we boil it down into our official rating and investment thesis for Vasta.
So, based on that solid growth, and especially on that incredible inflection point in cash flow, we are initiating our rating on Vasta Platform as outperform.
Our thesis here really stands on 4 pillars. First, you've got durable top-line growth, backed by real pricing power. Second,
This isn't just a one-time thing, it's a genuine, sustainable shift in cash generation. Third, they're using all that cash to pay down debt super fast, which makes the whole company safer. And fourth, they have these exciting new avenues for growth, like bilingual education and AI waiting in the wings.
So after all that analysis, it all boils down to one question, right? What's the actual trade idea?
As we see it, the trade is to be long Vista. We believe the market is seriously undervaluing this incredible turnaround in cash flow and how much safer the company is becoming. We see a potential 20% upside from here over the next year as other investors start to catch on. The key catalyst to watch for? The next earnings report. If they hit their full-year target for cash conversion, it will prove this turnaround is real and validate our entire thesis.
This is not financial advice.